Good morning, everyone. Thank you for joining and welcome to the viewers online as well. Now, we're going to have, like we had last year, with two of us presenting. So Emmy's going to kick it off. That's Emmy and me. We look alike. I think we look like our pictures now. Got shorter hair, a bit older. So these are the topics we're going to discuss. Emmy's going to discuss FBT overview, what's new in 2023, and then I'm going to come on an FBT exemption on electric vehicles. I get the good stuff. Salary sacrifice on EVs, arrangements, just breeze through that. There's quite so much there. And currently what's on the ATO radar. And I just want to leave 10, 12, 15 minutes at the end to answer some questions. I have in one of my slides put some questions that people have already posed. So that is in one of the slides. So we might kill some of those questions before the start. So Emmy, thank you.
Good morning, everyone. Hope you guys are all having a great week despite the rain. So I am Emmy. I'm a senior in accounting and tax division. So I've been working here for about 3 years and been working with Mariana very closely for those last 3 years. And I'm just going to be talking about and get us started on a bit of an overview of FBT, some rates, the relevant due dates, etc. So just to kick us off, our FBT year, as we know, is from the 1st of April 2022 to the 31st of March 2023 this year. The due date for lodgement is on the 22nd of May 2023, so in just over a month. If you do lodge with a tax agent, though, you do get an extension. So that extension will be till the 26th of June. So you get an extra month, essentially. But there is a catch, though. If you aren't already on our tax agent list, we do need to add you to that on the original due date, which is the 22nd of May as well. And we've just got a bit of a warning there. There are penalties, unfortunately, for failure to lodge on time, and it's especially important for those significant global entities, for which we might have some in the room here, to lodge on time, because they do attract a minimum penalty of $137,000, which is quite a lot. The ATO have actually increased their crackdown this year from the 1st of January on those SGs, so it's really important that we are lodging on time. So this year, the FBT rate is 47%. It hasn't changed for a number of years. Just with FBT as well, a lot of employers don't tend to provide fringe benefits because, as you can see, the 47% rate is quite a lot higher than the company tax rate of 30% or so. So it really needs to be sort of worthwhile for employers to provide those benefits. And I will get to it in a minute, but for not-for-profits as well, we do get a few not-for-profits providing fringe benefits because they're not necessarily taxable as well. The FBT gross up rates also haven't necessarily changed again this year. So the type 1 rate, which is the GST rate, is 2.0802, and the non-GST rate is 1.8868. And as you know, employers do need to report fringe benefits that have been provided to employees as well. So any fringe benefits that are reportable will need to be reportable at the type 2 rate as well. So some employers are can be exempt from FBT up to a certain cap. So we might have some not-for-profit entities here in the room. So public benevolent institutions, and will have a $30,000 cap. And also hospitals and public ambulance services as well will have a $17,000 cap for the amount of FBT that can be provided that will be exempt. That is a gross up rate though, so pre-gross up we need to kind of work out the amount there. So they are listed on the slides as well. And for all of those entities as well, they do have an extra cap, if you will, for any salary package, meal entertainment and entertainment facility leasing expenses as well, of $5,000. So we've just listed a few useful thresholds on the slides up there. So the main one that I think would probably affect most of our clients would be the reportable fringe benefits threshold. So you don't need to report any fringe benefits for a particular employee if they have any taxable values of less than $2,000. So you do need to start reporting that after that $2,000 mark, and that hasn't changed as well. The FBT commercial car parking threshold this year is $9.72. So that's slightly increased from last year's rate of $9.25. And we'll talk a little bit about commercial car parking later on. But do note that a number of our clients in particular, they are small businesses, so they might be eligible for a car parking exemption anyway. Another common one is the minor benefits exemption threshold that I'm sure a lot of you will probably know about. And that number hasn't changed, so that's $300 GST inclusive. And we've got some other rates listed up there if they are relevant to your organization as well. So FBT documentation. So we all know that FBT can be quite onerous on employers, employees, but as we know, it is really important that we do keep track of our documentation when we are preparing our FBT returns. So some of the common ones are listed up there. So using, if we are providing car benefits and we are using the operating cost method, we do need to keep a logbook or require our employees to keep a logbook every year. We'll also generally need odometer readings. So we've started sending out our FBT checklists to all of our clients. And sort of those questions are listed in there as well to give you a bit of a prompt as to what you might need. So you might also need relevant declarations signed by your employees. So, if you're providing expense payment benefits as well, or any loan benefits, etc. But our HLB advisors will tell you, and if we are preparing the FBT returns, we'll let you know what sort of declarations need to be signed, etc. And I've just got a last point up there about travel that we will sort of touch on later on as well. But at the moment, we do need to keep a travel diary if we are traveling for a continuous period of 5 or more nights. And we do want to sort of reduce our taxable value amounts on those potential benefits provided if they are going away on business travel. So just bear that in mind if you are paying for any travel for employees. So we've just listed some common types of exempt benefits, which I'm sure is very exciting to us all, but some of the ones that we do see regularly are listed on the slides, and I'll just touch on a couple of them as well. So as I mentioned, we do have a minor benefits exemption of $300 or less. So that's a really, really common one that our clients use. for providing benefits. So, you know, a lot of our clients might give out gift cards for $250 a year or so to their employees, which will be exempt from FBT. The catch with that one is that the benefit does need to be infrequently provided. So that means that you can't just provide a $200 benefit every week, or sending your staff like bottles of wine every 2 weeks or so. It does need to be infrequent, unfortunately. Work-related expenses as well. So if you do provide benefits that are work-related to your employees, they can be exempt from FBT if they are deductible to the employee themselves. So some things that might be relevant would be subscriptions to journals if they are relevant to their field. So I know for us, our firm pays for our CA things. So that might also be something that will be a work-related expense that is exempt from FBT. Another common one is sustenance. So if you're providing light meals and light drinks on a regular work day in your office, that's also not necessarily subject to FBT because it's essentially not considered meal entertainment for employees. So portable electronic devices is also a really good one. So if you're providing things like laptops, phones that are predominantly used for work to your employees, they can be exempt from FBT. So the ATO actually confirmed in the last year or so in a private filing ruling that smartwatches actually qualify for this exemption because it is considered a portable electronic device, but I did hear a few snickers there, but we just need to make sure that is work related as well. And for most small businesses with turnover of less than $50 million, there isn't really a threshold as to how many devices you can provide, but if you are over that threshold, you know, they need to be, you can only provide one device that has substantially the same. And also we've got electric vehicles at the end there, which Mariana will talk about later as well. So what's new in 2023? We'll jump right in. So Mariana is just going to talk about this in a little bit more detail later on, but essentially last year there was a new bill that was introduced into Parliament that received royal assent in December 2022. So there is a new exemption, FBT exemption on electric cars specifically, which will apply to those qualifying car benefits that have been provided on or before 1 July 2022, so last year. Now, there are some conditions that you do need to follow for those exemptions. So firstly, the car that's been provided needs to be a zero or low emissions vehicle. It needs to have been first held or used after 1 July 2022. The third condition that you do need to meet is that the car is used by a current employee or their associate. So as some of you may know, FBT actually not just applies to current employees, they will apply to former, current, and future employees. But in the case of the FBT exemption, they do need to be current employees and their associates. And the last condition is that luxury car tax has never been payable on the sale or importation of that car. So currently that rate, that number is $84,916, which might be a little bit limiting if you are providing benefits or car benefits that, you know, things like Teslas and things might be over that threshold. But Mariana will talk about it shortly. Now, similarly, if you are providing those electric vehicles and cars, the car expenses will also be exempt from FBT. So things like rego, insurance, repairs and maintenance, fuel such as electricity on those electric vehicles will also be exempt. But we have included a warning there. So unfortunately, the ATO have confirmed that if you do provide a home charging station to your employees as well as the car, that portion of the benefit will not be exempt. So you will still have to pay FBT on those. So last year as well, the government introduced 2 new bills into Parliament to help employers keep up essentially with their record keeping requirements and make it easier for those employers. And they were proposed for 2 specific record keeping requirements in the first instance. We might have a little bit more in the future, but for now it's only related to travel diaries and relocation transport. So as I mentioned before, if you are sending your employees on a work trip and it is for a week or so 5 continuous nights or more, they will need to keep a travel diary if you do want to say that it is otherwise deductible. In this proposed bill, they are essentially alleviating or diminishing that requirement. And essentially, they do have a few different types of records that you can rely on other than a travel diary to substantiate any reductions in your taxable value. And the other bill that was introduced was in relation to relocation transport. So at the moment, if you've got an employee that's relocating to another country or another state, for example, and you pay for their flights or their fuel costs for them to drive there to permanently relocate, you do need them to sign a declaration for that. So this bill is also proposing to diminish that requirement as well. So we've listed sort of the types of records that is proposed to be able to rely on essentially. So things like if you've got correspondence with your employees, so your employee sends you an email saying, for travel, for example, on this day I will be attending the conference that you sent me to, but on the very last day, I'm using that as my free time. So, you know, any emails or text messages can also be used. Another common one that I think will be taken up is also work calendars. So if your employee is traveling and they're keeping up to date with their work calendars, you can use that as well as part of your record keeping requirements, and also things like logbooks. If you've got specific policies in place as well, you can use that. So it's essentially, like I said, trying to alleviate the stress of the record keeping. There is a bit of a warning though, because the bills haven't received royal assent, they won't actually apply for the 2023 FBT year. But if it does, that will apply from 1 April 2023, so the 2024 FBT year. So unfortunately for this year, we do need to keep our records as they previously were, but we'll keep you updated on that as well. So car parking benefits, we have spoken about this for a few years now, and it is finally the time to apply it. So from 1 April 2022, the new tax ruling that the ATO have released, well, they released it a few years ago now, will apply to car parking benefits. Now, this is really only relevant to employers that are that have turnover of more than $50 million, because as I mentioned earlier in the presentation, small businesses actually do get a car parking exemption. So if you are a small business with turnover of less than $50 million, this change won't necessarily apply to you, but you know, it is important to keep it in mind. If you do ever tick over, for example, I'll skip to the next one, but essentially that change, as a recap, was to include commercial car parking stations, to expand the definition of commercial car parking stations. So previously, commercial car parking stations did not include things like shopping centres, hospitals, hotels, universities, that kind of charge a bit of a penalty rate for staying there. So they weren't necessarily considered car parks. And if you do provide car parking benefits, that will be relevant because the law basically states that you're providing a car parking benefit if you've got a commercial car parking station within a 1 kilometre radius of the employer's premises. So that's affected a few of our clients that are medium to large businesses as well. And I'll just click back quickly, but essentially there was a bit of confusion about this ruling last year. So the former government did announce that there was going to be a potential repeal to this ruling, although we didn't really hear anything else from that. And the current government really stayed a little bit silent on the topic. So unfortunately, it does mean that the ruling will apply from April of last year, so from the 2023 FBT year. So if that does apply to you, then our advisors will reach out and let you know that that's something that will need to be considered for 2023 as well. And just the last one on what's new in 2023. So in the last year or so, there's been some recent High Court rulings about specifically the definition of contractors versus employees. So as we know, we only pay FBT on benefits provided to our employees, not our independent contractors. So these two High Court rulings are actually really important for FBT, as well as other things like super, etc. But essentially, in response to that, the ATO have released a draft tax ruling and a bit of guidance as to what those rulings will mean. So previously, the contractor test used a multi-factor rule. So that means that the employer could look at a number of different factors, like the relationship that you had with that contractor, the contract itself, you know, maybe how you interact with them as well. But essentially those rulings that were released last year essentially changed that test. So now we only really look at the substance of the contract. So, you know, if it's written more like an employment style contract, then, you know, things might have changed for some of your independent contractors. So we are recommending businesses to evaluate their existing contracts with their independent contractors specifically, just to make sure that you know, they're still considered contractors going forward. And so once we do that, we'll just need to consider the FBT exposure as a result of those changes. So if you're not too sure, feel free to reach out to our HLB staff, and they can definitely help you with it as well. So now I'm just going to pass on to Mariana to talk about some more fun stuff like electric vehicles.
Okay, electric cars. So why did they bring out this legislation for electric vehicles? Why would they want to exempt electric vehicles? Well, the EM says that really they take into consider environmental issues. And if you have a look, electric cars are more expensive than petrol cars. So a car may cost you 25 to 30,000, whereas an electric equivalent vehicle would cost you about 45. So the government's intervened to say, well, let's put something in place. Let's revise it in 3 years' time and see if this works. Gets employers buying or salary packaging more electric vehicles. So you've seen this slide before. Great news for employers and employees. Also for the for-profit and the not-for-profit. You still need to, and I'll come into both of those in a minute, you still need to have a car. Okay, so the definition of a car is still there. So that means carrying capacity of less than 1 tonne and carry fewer than 9 passengers. So you still have to have the car. If it's not a car, you don't get this exemption, even though it might be an electric truck. Prior to these changes, electric cars, you know, basically weren't exempt from FBT, unless maybe you had an exempt vehicle, so somewhere else in the FBT Act. But those were stringent requirements which really applied more in limited circumstances where, say, the utes, you know, your private use was very limited. You drove the ute to the office, you used it every day, all day long, and then drove back home. Anyway, the scenario there goes on forever, but that's the main sort of exemption that existed, if you like, before this. You still need to calculate the reportable fringe benefit. So think about that, still have to keep some records. So it's not completely free of record keeping. So it's the 2000 threshold, as Emmy said, hasn't really changed. They index everything except that. So the threshold would go on the payment summary. It's very important for an employee, maybe not for an employer, except getting the compliance right. Now, the thing is, the exemption does apply for pooled or shared vehicles. So it doesn't go on the report of fringe benefit. More to come on that. And I'll go through the criteria. And what's important here is the criteria. So you can see this starts from 1 July 2022. So for the 31 March 2023 FBT year. So we're in play. It only applies for electric vehicles. So you may ask, what's an electric vehicle? So zero or low emission vehicle. So your battery electric vehicle. So that's your Tesla, Hyundai, Lexus, Mazda, Volvo, Mini. There's probably more that have electric vehicles. That sounds great, fantastic. I have a Tesla Model 3, but unfortunately we're over the threshold. So, and you know, I'm not packaged and it's not through work, so it doesn't really matter. But just to give you sort of an idea. Hydrogen fuel cell vehicles. Well, they're not really publicly available in Australia. I understand that Toyota and Hyundai have them. You can order them. So, great, thanks. And the other one was the hybrid vehicles. Now, they've got to be plugged in. So you plug them in, they've got a cord, and then, you know, you fuel them up with something else. Now, I think that would be more used in regional areas where you've got more kilometres to travel and don't want to run out of electricity, a battery, I should say, and so you can fuel them up. Now, if they're not plugged in vehicles, this does not apply, this exemption. Okay, so really trying to get people to use these electric vehicles. If they're electric vehicles, not a car, as I mentioned, it's a truck or something that's not a vehicle, it doesn't apply the exemption. It is available for fleet cars, salary package vehicles, etc. But you've got to keep in mind that they're higher costs of the vehicle as well. So may not pay FBT on it, but it may affect the employee from a reportable perspective. Reportable fringe benefit, why does it affect the employee? Childcare, Medicare levy, other things that may cost them. For not-for-profits though, what's interesting is that they've said that the EVs not form part of the cap. So it doesn't form part of the cap itself. So it's exempt. So it shouldn't technically form part of the cap. So if you think about it, a not-for-profit, so those that are for-profit pleasures. So if you're not-for-profit, you have that cap of 30,000 or 17, depending on what you are. And then normally people, so you might salary package, you've got 100,000, you say, oh, I want a package, I don't know, 15,000 on my mortgage or something like that. Now you could probably package a vehicle and it doesn't come within that cap and it's still exempt. So that sounds really good, doesn't it? But again, people need to live on something, so they need to have some cash. But the catch is they still need to put it in reportable fringe benefit. That's the catch. So you can package that with everything else. So that's good. That's really advantageous. But there's still some work for the employer. Now, as I've just gone there, we've defined electric vehicle. We want to define what is first held and used, and then what is electric car tax. I want to run through each slide. We'll want to cover one of these items. So electric vehicle held or used on or after 1 July 2022. And there's some guidance that have been brought out by the ATO, so it's publicly available. Held or used. So it can be second-hand cars, it can be imported, it can be leased. So remember, lots of bona fide arrangements. So just like your car benefit. So it's got to be owned, including hire purchase, leased, etc. So same sort of rules there. If owned by employee, then the EV is not considered to be held by employer. Obvious, right? It's not a benefit being provided by employer to employee. How do you know who owns the vehicle? Look at registration papers, insurance policies. I mean, kind of obvious. Maybe, maybe not. First time the car was used either by employee or member of the public, including companies, must be after 1 July 2022 in order for the car to be exempt fringe benefit. So effectively, you look at the vehicle identification number and you know when it's manufactured, you can tell the model. Why is all that relevant, you ask? Because it sounds pretty easy, right? 1 July 2022, started held, used. So take for example, a car gets delivered by the employer, 30th of June, delivered on that date and handed over to the employee 1 July, that's probably okay. That's might be a new vehicle, that there's no problem there. And because it's used 1 July. I think what happens is that these vehicles will eventually get sold and passed on. And what's really important here is that first held or used is important for the luxury car tax limit. So if that vehicle is then, so you got a new car, say you get a new car 1 April 2022, it's provided to the employee, no luxury car tax applies, it's not after 1 July 22, not exempt. Okay, so that's easy, that's easy. But what happens if you're reselling it? Would the EV exemption apply? Would you be entitled to the exemption going forward? And the answer is you have to still go back and look at when it was first used and held. So that vehicle was bought pre-1 July 2022 and sold, say, in September 2023 or 4 or something like that, then effectively, no, you don't get that EV. So that's when you might have to look at the vehicle identification number and go, okay, when was this manufactured? Will I get this exemption? That's a quick way of looking at it. And that's pretty important point. So if you get your head around that. So today I buy a vehicle, no luxury car on that. I resell it. I'll go, I'm the purchaser or the employer. I'll probably have to look at the VIN if they can't tell me. Look at the model of the vehicle. Was it manufactured after 1 July 2022? Tick. Okay. Would it have had luxury car tax on it at that time? At that time, if if you say yes, no, it didn't have it, tick, okay, I'm probably in. But if that vehicle was before 1 July 2022, you're out. If the vehicle even was bought after 1 July 2022 first and had luxury car tax on that, I'm buying it now in this period, secondhand, it doesn't have luxury car tax on it, but I still have to go back to when it was purchased and identify it was after 1 July 2022 and see if it had luxury car tax. So that's the tricky thing a little bit about it. Probably not today, but going forward as you're going and reselling or buying as an employer cars, packaging, etc. Normally packaging vehicles, but now the other thing that they've got some rules around the hybrid, the plugged in. So I'll go back onto that. So luxury car tax, as I identified, when you first buy the vehicle, does it have luxury car tax? Now, how do you know? Look at the invoice; it tells you on. And usually there is a limit every year that the luxury car tax applies, and that is the. I'm just trying to look for it. Funny, I didn't put it in that slide. 84,000, something along those lines. Let me just see which slide I put it into. Anyway, it's in one of my slides. But anyway, 84,000. So there's luxury car tax. Don't confuse that with the car depreciation limit, by the way. And I'll go through that in a minute. So you've bought the vehicle, you've had to look, it's after 1 July, there was no luxury car tax, we're in. So you think it's over by then? No, you still have to work out a reportable fringe benefit. So I'll go through that. Now, I think, you know, you may not have all that information. As I mentioned, if you're buying a second-hand car today and you don't have that information, go back to the vehicle identification number, find the vehicle model, find the price. It's all available. Just with the plug-in hybrids, you've got a little plug, you plug them in. Government said, so 1 April 2025 onwards, they only have until that time to have exempt vehicles. So the only thing you can have longer, if the use of the plug-in vehicle was exempt before 1 April 2025, so it's a continuation of the contract effectively. And you have a financial binding commitment to continue providing private use of the vehicle on or after that date. So again, it comes back, you know, it's just a continuation. But if it's a new employee you give it to, you break the contract, probably wouldn't apply after 1 April 2025. I think we'll have more information by then anyway. The thing to remember is that these rules are going to be revised in 3 years. So if you look at it, we've started from 1 July 2022, 23, 24, 25. So at 30th of June 25, the government will revise these rules. Are they going to keep it? I don't know. Will they have a grandfathering? I don't know. But those are the kind of things that we think about. But at least for the next 3 years, we're good. So working out the reportable fringe benefit, you have to work it out. Now, generally they're exempt. So they're exempt benefits. So yes, normally excluded. So for all for-profit or not-for-profit, it's part of the reported fringe benefit. Except it's a pooled vehicle or shared vehicle. And pooled and shared could be that, for example, I had one employee had it for a portion of the year, another employee had it for another portion of the year. That's exempt. So you don't have to basically keep that, do that calculation about whether you have a reportable fringe benefit. Now, for those that you recall, how do you calculate the reportable fringe benefit? You've got the two methods. Take you back just to what a normal vehicle looks like, statutory method and the operating cost method. So you recall how to calculate that. So that does mean that you have to keep that documentation, right? Now, there's a little struggle here because what's the motivation from an employer just to basically keep, oh, well, I know what the car costs and odometer readings potentially. An employer is not going to care whether it's for private or business because it's exempt. From an employer's perspective, you may have package, even if you're not, the employer doesn't pay FBT. But there's real an incentive for an employee more than an employer. So if for an employee uses it mainly for business, they could keep a logbook and give you the logbook. And then when you're doing the calculation, it reduces the reportable fringe benefit amount. So that's the purpose of it. So you can sort of see that's probably more going to affect an employee Now, which employees is going to affect? Probably those employees that a reportable amount is important for them. So if they put that in their payment summary, it's going to affect their childcare, their Medicare, what else? The parental leave, paid parental leave, etc. So it may not be for every employee. So those that don't care probably won't provide you necessarily with a logbook. They'll just go, calculated, whatever, and I'll just put it in my payment summary. But it is something to keep in mind. Now, what expenses can you claim in operating cost method? Now, remember the statutory method is cost of vehicle times 20% in most cases, then amount of time held. Now, you're not going to hold it for the whole year because it applies from 1 July, potentially, and then any contributions. And contributions could be reimbursement of electricity costs. So there's a bit of a calculation to do that, and we'll go through that in a minute. Now there's got to be some of those things are, what do you normally include? Your registration, nothing new there. Insurance, repairs and maintenance, fuel, if you've got that hybrid vehicle, plugged in hybrid vehicle, non-plugged in, no, not exempt. And electricity, that's a new one. So ruling PCG practice compliance guideline, the ATO has just brought out in the last week, basically saying how to calculate electricity, because that was the hoo-ha. Now, I know some of the Teslas do effectively provide you some with electricity. I don't know if it's just the use of electricity or whether the cost of electricity, I don't think it's the cost, but just the use of it. But effectively, the government has brought out a guidance on that, which I'll go through. So costs of electricity, just a warning, the home's charging station is not exempt from FBT. So employer wants to either package in the lease, that has to take it out of that package, because it won't be called part of the exempt vehicle. So you'll pay FBT on that. The other thing is that the main thing is the electricity. So the cost of the electricity itself, if you're charging it at home, how do you know what that looks like? So they brought out a compliance guide saying that in effect, you can use this, it's a choice. You don't have to use it. But effectively, if you use this, you can't use anything else. So if you have, you charge at a commercial parking station, you sort of charge at home, use one or the other. You can choose to use this compliance guideline, which is 4.2 cents per kilometre, for 4.2 cents per kilometre. So that's easy, you've got 4.2, work out how many kilometres. So how are you going to work out kilometres? Well, in the first year, they'll say a reasonable basis. So you can, you use logbooks if you've got them. You can use last year's, open your odometers and work it out reasonably. What if you're doing the same thing? You can work out how many kilometres you did do. Going forward, maybe a travel diary. I know when you have a fuel card, it sort of tells you what you begin with and end with. So you might have all that information readily available. Now, if you choose to use this method, the 4.2 cents, the ATO won't use compliance resources, to look at that. So they'll accept that if you're using it. It doesn't apply to plug-in hybrid cars. Kind of makes sense because, you'll have some sort of fuel with that. So that'll be your expense, the fuel expense. So you can't use this method, but you can, if you use a commercial car parking station to plug in, I'm sure you can use that in combination. It doesn't say anything that you can't use fuel and electricity. It just says that if you have solely an electric car, you can't use both methods of a commercial parking station charge plus the 4.2 cents methodology. What else did I want to say on that? I think there was quite a bit in that. I mean, you've got to pay electricity at home as well. You can't just, make it up. And we've talked about the odometer reading, etc. But that practice, and I think it's 2023 D1 for those that want to look it up. So the other thing that car expenses, which was interesting, I didn't really realise this, road user charges to SEV cars, not implemented in New South Wales. It's being deferred until 2027, but I understand Victoria does have that. Always thinking of ways of making money, aren't they? So you have this charge, which is not for, I don't think, petrol cars. Installation, as I said, of charging stations in your home if you reimburse an employee, if you pay for it, FBT exemption doesn't apply, it'll be FBTable. Now, interestingly, they say that a cost of a battery replacement, now they're pretty long life, those batteries, but if you're replacing it for a modern day like equivalent of battery, that'll be all right. It'll be a repair. But if you're upgrading and you're getting more power out of your battery, that's likely to be a cost-based item, so it'll be a cost of the vehicle. So it won't be a repair. Items that aren't car expenses, global positioning systems, subscriptions, car parking expenses while charging, just to be aware of. Unless car parking exemption applies and it's your car parking, all those other things. What else was there? Oh yeah, non-business accessories which aren't exempt and form part of the base value of the vehicle. So if it forms part of the base value, it increases the car cost. So think of anything that your additions you might ask for: alloy wheels, rear spoilers, seat covers, paint protection, rust protection, window tinting, personal license plates, upgraded charging cables fitted to the EV. So, if you purchase additional electric charging cord, it's a property fringe benefit, not part of the cost base of the vehicle. All little nitty bitty things that we love about FBT. Now, in the next one, some of these questions were raised previously on an email, so it might answer some of your questions. And I hope those that wrote the questions, I've got it right, I understood what they're saying. And we can have some questions. Emil's feed up the last bit, and so we can have some questions, or if you want to ask them as we're going through some of these questions. So one of them is, can we gift a car, an EV car, and not pay FBT? No, that's not right. It's car benefit, so it's only being provision of a car, not a gifting of a car. So you still have to use market value. When calculating depreciation, does a cap apply? So that's not necessarily for not-for-profits. That's talking about when you're looking at your operating costs, how you get your depreciation up to the car limit. And just to be aware that using the car depreciation limit, that is correct. And so assuming that, the luxury car limit, that's 84,916, you purchase a vehicle that's worth 70,000. When you're working out the operating cost, assuming you're using that, you're saying, okay, can I get depreciation on wholesale? No, it's on the car limit, which is 64,741, just to confuse everyone. And that changes every year. We've talked about being revised in 3 years, the EV. So because it says here, how long will the exemption apply for? Well, indefinitely, hopefully, but there's a revision going to be had for the 2025. And plug-ins, it says definitely it finishes, unless there's just continuation of that particular contract. Then it said exempt vehicles from payroll tax. Well, if there's nil benefit, there's no payroll tax, but the state governments are considering to amend the payroll tax to include, so yeah, well, one's federal, one's state, so they don't want to miss out. FBT exempt or rebatable, are they included in the cap? No, they're not included in the cap, but they're still reportable. Question, already gone on. Can a rebatable employer get an FGA, small business car parking exemption? That's really what I think they're talking about there. I guess under, yes, they can. I think I missed a question, but anyway, let me answer that one. Yes, you can potentially get exemption, but you have to look at the criteria. So 58GA is for the small business vehicles. So make sure you fit that under criteria. It's moved to that 50 million. Whereas there's a 58G, which is for exempt employers. So that is limited, but that is for your PBIs and hospitals and other entities. So you have to look at the classification and registered charities, effectively. Now, I missed one question. Electricity costs form part of costs of EV. yes, they form part of the costs, so we've covered that off. So I think that's clear. Managing car parking as part of salary packaging, so building owners don't have to deal with individuals. I'm not sure where that was coming from, because I would have thought, and if you raise that question, you can clarify with me. I would have thought that if you're actually a vehicle, you're talking, you're saying, well, how many car parking spots do we need? You're negotiating that anyway with building management. You've got a policy around it. And car parking is usually, you're not exempt, by the way. So you're over that threshold. You have to look at how many spaces. There's 3 different methods. And then once you've chosen a method, you have to choose a method as to the calculation of it, market value, and there's a standard rate, etc. This was an interesting one. EV tax deductible in a company, income PSI, car 100% private use, can GST be claimed up to the car limit? So a car's been bought in a company. If the car is provided and it's an EV car, it meets the criteria provided to an employee, so a director can be an employee, so you have an employer-employer relationship, then, EV is exempt from FBT. You potentially can get a car deduction up to 30th of June, because there's that temporary asset write-off. The question about the GST, not really an FBT question, guys, come on. But you basically, yes, you can only claim GST up to the car limit. So car depreciation limit is a 64, not the luxury car tax limit. So there are exclusions, or there are some scenarios where you can get more, and that is if it's an ambulance being provided, it's a trade, it's a trading stock, a car. So there are specific scenarios that can be exempt. Sorry, you can claim the full GST amount. What's the other question there? Oh, yes. So just remember, if you're a sole trader and you buy a vehicle, you can't claim the FBT exemption. You probably don't even have the FBT because you're not an employer-employee relationship, but it makes it a bit difficult. Primary production, this was an interesting one. I'm not too familiar, but primary producers and EVs, what is the treatment? Basically, if you're a primary producer or you're in the tourism industry, I understand you can get a refund or not pay luxury car tax. So the question is, can you claim the EV exemption? It's likely not to apply because the legislation at the moment, reading it strictly, says that you would have had luxury car tax imposed. So there's more guidance to come out, and I think this guidance has been sought by the ATO. But at the moment, I would just be conservative on that one. So if you did get a refund of luxury car tax, you can't get the EV exemption at the present time. Tax exempt bodies and rebatable entities, entertainment. Wow, bombshell. Thank you for asking that question. Look, I didn't get time. I wanted to put together a little slide, and I'll probably bring that into the next FBT next year. But it is quite a complicated area in the sense of, I think the best way to think about it is that FBT exempt employer, tax exempt body, or a tax exempt body can include an exempt FBT employer, PDIs, etc., or a rebatable employer. So it sort of fits under that category. The only difference is that almost like the rebatable employer is treated like a taxable employer, except it gets a rebate, gets a reduction, and it gets that rebate up to the cap. Whereas a tax exempt doesn't have to worry about that. They only obviously get the FBT, the exemption up to the cap. After that, everybody pays FBT. So, and then, if you're looking at it from an FBT, from tax, GST, it'd be nice to have a little one box, but I didn't get time to do that, so I apologise. So happy to talk to you after the session. Now, I'm conscious of time. What is the time? Thank you. I want to answer some questions. So I'm just not, I've put a bit of salary sacrifice example in here, which you can go through yourself. And you can ask me any questions, and I won't charge you if you ask me questions. But I think the main thing to be aware of there is that, it does save employees money. So it is a good thing. Now we're trying to keep employees, this is something you can use in your packaging. So that's what that's about. Amy, do you think you can cover it in a few minutes or? Yeah, she's going to go. She's going to try. And then we'll have questions at the end and we can ask some of those relevant to yourself.
So, just the next section, we're just going to be talking about quickly some of the things that the ATO is currently looking at. So very briefly, the ATO do look at some income tax return labels to identify whether or not FBT applies. So if there are some discrepancies between FBT returns lodged and your tax return that's been lodged, the ATO can review your FBT that you provided to your employees. So these are some of the labels that they might be looking at more closely in relation to FBT. The ATO do have a bit of an audit spotlight as well on some specific issues that they've encountered. So the first one is motor vehicles themselves. So failure to identify or report any motor vehicle benefits is one thing. So in your income tax return, you've got motor vehicle expenses as a disclosure item if you are a company as well. So the ATO, if they do identify that there are motor vehicle benefits provided, but you don't necessarily pay any FBT on motor vehicles, and that might be something that they look at. Some of the specific things that they have identified is incorrect application of the exemptions that do apply to statutory formula methods, and also treatment of the travel expenses as business related as opposed to private if you don't have your appropriate records and supporting documentation. FBT employee contributions. So the ATO also look at mismatches between amounts reported in the FBT return and the income tax return. Entertainment as well, the ATO will look out for expenses that might be classified as sponsorship or advertising and look at whether or not there actually is an entertainment aspect to that. So yeah, it is important that we differentiate between sponsorship and advertising when we're looking at FBT. And the very last thing is car parking valuation. So if you're a small business, again, might not be relevant to you, but one of the methods of calculating your car parking benefits is using the valuation method. So the ATO have found that some employers that are using this method are not obtaining proper valuation reports to support their car parking fringe benefits, and they do look at discrepancies where there is a nil market valuation or valuations that have been significantly discounted for FBT purposes, or if the car parking rates are not necessarily representative of commercial car parking in the area. So now we'll get on to questions.
So does anyone have any specific questions that have been going through your mind that we haven't answered and you want to just test us? I might not have an answer. Sorry.
Slide, before the slide down, just to see the one that showed the analysis that was done. It's say the car's worth $20,000 or $30,000 more than the white petrol car.
So this RSA price one, was it? That one?
Yes. So in a nutshell, you say that it's still worthwhile. Like in approximate terms, using that analysis, how much better off with the employee with that factor on the car?
Yeah, I think that well, I guess the fact is there, it just sort of tells you depends whether they've contributed or not, that they have contributions. So there you're only about $2,000 better off, aren't you?
That's what
yeah, that's right. So but there's also other things but to think about there. That's a really sort of very simple example, very general. Yeah, looking at the car amount, whether contributions were made, and I think we've got one here. to sort of show basically, we didn't really have the net amount there, so it's sort of hard to put on a slide. I think in most cases, you really have to do a case by case to see, you know, who is the person being provided with that benefit. What would it have looked like? For example, if someone's under that 180, you think about it, it's 47 cents in the dollar. If you don't have an EV and it's not exempt, right? Is it really worth providing a car to them? You know, you've got to think, and you know, it's mainly private use, not business use, because their tax rate would have been less and they're paying FBT at 47 cents. Whereas if it's someone that's 180,000, you know, they're going to be paying at a higher rate anyway. So that might be worth more their while to get a car. And so what are you comparing? You're comparing a petrol car with someone over 180 to an electric vehicle. So I think it'll give you different results. But it's a good exercise to do, and happy to do that for anyone. Not for free, but I'll just stay there. Depends if I like it. Any other questions? I think once you get into it a bit more, I don't know, how many here would provide electric vehicles to their employees? Let's just ask that. In a fleet or an novated lease or some scenario there. What about online? Anybody? That'll take a little while. Yeah, so knowing that there's an FBT exemption and having thought about it a bit, how many of you would consider providing exempt vehicles or electric vehicles, sorry, to your staff? Yeah, so it's a couple, right? Still not overwhelming considering, you know, it's another change in the, you know, the FBT rules and a bit, not more work, but you still have to assess, right? It's not like so simple.
Yeah.
I'll have some, yes, online.
Online questions. The food and drink on premises exception, please remind me, does the exception only apply if the F&D is made available to everyone, or can it just be to the executive team, for example, and still be exempt?
So it depends. Are you for profit, not for profit? If you're for profit, you have the actual method or 50-50 method. If you use 50-50, no. But the question is it entertainment or sustenance? Yeah. So if it's sustenance, you know, a light meal sustenance, you probably don't even come within the FBT regime. And there's a tax ruling 2017, something like that. There's a ruling which the ATO bring out, which lists everything in nicely. And I think we did a bit of a matrix in the past. I don't know if we can circulate that or we have to do a lot of modifications to it. It's a bit old, but we can circulate that as well. With the slides, it gives a bit more work for the team. But in effect, so yes, you can provide to everyone, but it depends, because if you're for profit, if you're using the actual method, yes. But remember the 50-50, everything goes in the pool if it's not sustenance. And if you're an FBT exempt entity, again, if it's not sustenance, there's exclusion from property benefits and potentially. And also there's the minor benefit, you only get in limited circumstances. So that's why I say it's a bit loaded and you really have to go specific. I really appreciate you coming in. I thank you. If you do have any questions following up, please email Abby and myself. We're happy to answer them. When it gets too convoluted and specific to facts, we will charge you a fee. But if it's in something we can answer straight away, we're happy just to, you know, talk to you. All right. Thank you very much.